Hello, good to be back. And I always like to start with a summary of the syllabus. Remember, I said for audit, we're going to look at it as a project, and for every project, you always have to plan before you execute and you report. The same way our audit is, and we said everything we do from the planning to execution to reporting is guided by the audit framework and regulations, which is the section A of the syllabus which we have done. This is section B, C, and D, and E. I always want you to have a full syllabus in your head so that as you progress, it start making sense to you. We've dealt with section A of the syllabus in the previous 3 videos. I'm glad you have watched those videos, which is good and impressive. Now, we want to look at section B of the syllabus, which is about planning. So I'm starting with section B today, and that is about planning, audit planning. And I'm sure you agree with me that whatever you want to do, if you don't plan before you do it, if you manage to succeed with that, you are just lucky. It's just an element of luck. So most times you don't succeed with anything you fail to plan before you start. Or even if you succeed, probably you wasted a lot of time, you've wasted a lot of resources because you did not think through it with the end goal in mind. So the same way, audit planning is very important. So I'll start with why do we need to plan an audit? Why? Why do we need to plan an audit? Why don't we just go to the client side and plan it? Because of what I've said. Because we want to be successful. So we want to have an effective audit, and we want to have an efficient audit. So it's because of effectiveness and efficiency. Effectiveness means we want to achieve our objective. And what is our objective? To issue the right opinion, which is audit report about the affairs of the company. And what is efficiency? Efficiency is making sure that we maximize resources. So we don't waste resources. We don't use too little and we don't use too much resources. And when you're talking about resources, we're talking about time, you're talking about people, you're talking about tools. Yeah, all of that are your resources. So these are all the things you need when you are planning an audit. And we'll go into the details of what audit plan is all about. But let's just peel the concept gradually so you can understand. So this is why we have to plan an audit, because we want to be efficient and we want to be effective. And when we talk about effectiveness, we say we want to achieve our objective. And the objective is to issue right opinion. Yeah, which means correct opinion. We want to issue correct opinion. So this means that there is a possibility that we might issue a wrong opinion if we don't plan very well. And that takes me to what audit risk is all about. So our major response to audit risk starts from planning. And what is audit risk? Audit risk is just basically saying the tendency of auditors giving a wrong opinion on financial statements. So what we're saying here is, generally speaking, a good opinion which every client wants is that auditor saying that this financial statement represents true and fair view of this company. Yeah, and everything is being stated correctly in all material sense. However, Auditors can make that sentence, and that sentence might be wrong, which means the financial statement contains significant error. However, auditors have failed to identify it. Because they failed to identify it, or they identify it, they covered it up, or by any means, they issued a clean opinion when the financial statement is truly not correct. So you have a clean opinion, which means you have stated that the financial statement is free of material error. However, the financial statement contains error. In fact, significant error, which is similar as material error. So this is a wrong opinion. When you issue this kind of opinion, a clean opinion, when there is this material error, what you have done as an auditor is to issue a wrong opinion. And this is really bad. That means that audit failed. That audit has failed. So the tendency of this happening is called the audit risk. That is the audit risk. And one of the ways we try to avoid the audit risk is to start the planning properly so that we can have an effective audit. And that's why we're going to spend so much time on audit planning. Yeah. But I want to explain these audit risks properly. Yeah. Because you remember, the audit risk is saying that the auditors have failed to notice the material error in the financial statement. So they need, what are the things that can now contribute to those material error? And that is what I'm going to be breaking down for you gradually here. So when you talk about audit risk, you're actually talking about three components. So I will break it down like this to tell you that audit risk is actually equals to inherent risk, inherent plus control risk plus detection risk. So there are three components of audit risk: inherent risk, control risk, and detection risk. And I will explain each of them. Inherent risk is just the risk that is, as the word states, inherent, that is in the nature of the business. Yeah, so it's about the nature of the business. Let me put it like that. It's about the nature of the business. Take, for instance, if you talk of tech companies are always going to be exposed to fast-paced technology. So obsolescence would be a major factor to consider in tech space. Yeah, fashion. You'll be talking of trend. All of that, because of the nature of that industry. You go to real estate. If recession is big in real estate space, if you're talking of financial sector, credit risk will be a big factor in that space, right? So like if you're talking of banks, you'll be talking about default in loans. So credit risk is big, right? You're talking of real estate. Likewise, recession impact will be heavily involved. Yeah. So there's some risks that are just specific to the industry or to the business that a particular company is operating. For the financial management student, who is doing FM right now, this is when you talk about your asset beta. Just to digress a bit, but if you've not done FM, don't worry, you will see it. But this is asset beta. That is a risk specific to the sector that a particular company operates. The second component of audit risk is control risk. And what is control risk? It's just saying that, first of all, do you know what control is? Let me not just jump into the control risk itself. Let me define control first. So here we're talking of control risk. But let me tell you what control is first. So control is just the process, the policy, or we can say guidelines put in place by board or management of a company to prevent, detect, or correct errors. So that is control. Control are those processes, those policies, those guidelines that have been put in place by the management of a company to ensure that they achieve their objective. And how do they achieve their objective? By preventing, detecting, or correcting errors, right? However, control risk is now the risk that this will not happen, which means those controls in place will not achieve those objectives. So the risk that controls will fail to achieve its objective, which means controls fail to prevent or detect or even correct error. Remember, error is also called misstatement because those are the words you will start getting used to in audit paper. Error is also called misstatement. Right. So that is control risk. So take for instance, you might say, oh, I have a control to ensure that we detect any errors in our bank statement. What is that control? That control is probably called bank reconciliation. Yeah, so that control is called bank reconciliation. And you think, okay, I do bank reconciliation, so I should be able to prevent or detect or correct any error in our bank statement. However, it doesn't work all that easy because there are three things that contributes to this control risk. And please take note. So control risk, when you look at control risk, three things might be happening why you have that risk in your audit risk. The first one is that there might even be lack of control. It might be poorly designed, and I will explain what that means, or not operated properly. Let me explain this with this bank reconciliation example. So to make sure that we detect error quickly in our bank statement, we plan to do bank reconciliation. So bank reconciliation is meant to be our control that will detect the error. Yeah, remember, a control can be a preventive control, can be a detective control, a corrective control. Bank reconciliation is an example of a detective control that's meant to pick error and correct it. So both detective and correction. Now, if we don't have bank reconciliation at all, we don't do it at all, we don't even know about it, that's a lack of control. So there is no control in place. However, if we have said that we'll do bank reconciliation, but we'll do it once in a year. Bank reconciliation is a control and it exists. However, the design is poor because you cannot do reconciliation once in a year or once in a quarter or once in 6 months. At a minimum, you should do your bank reconciliation every time you have to prepare your account, which is usually monthly, right? So that's a poorly designed control. However, we can say we'll have a bank reconciliation process and we'll do it every month, which means we have control. It's perfectly designed. However, if we don't do that reconciliation until maybe once in 6 months or once in 3 months, because people are just relaxed about it, they don't think it's that important anyway, nobody is supervising them to make sure they do it, then the operation is bad. You can see in this instance we have designed, we have it, however we are not operating it properly. So that is, all of this can contribute to control risk, and that is what control risk is all about. So if any of these three present, you're going to have a control risk because the control will fail to either prevent or detect or even correct error, and that means control will fail. Now, the third one is the detection risk. Now, before I mention detection risk, you will discover that control risk is by the manager the board of directors, you can see, and the management, they're the one that needs to put control in place. So it's more relevant to the company. Likewise, inherent risk is relevant to the company, because we said inherent risk is exposure coming from the sector. Yeah, this is exposure because you play in that particular sector. So this is a sector exposure. It's your industry exposure, right? So it's about the company. Control is about the company. However, detection risk is different. Detection risk is about the auditor, and that is where you have control. You don't have control over the control risk. You don't have control over inherent risk as an auditor. But detection risk, that is where the auditor has control. So this is where you have focus, because that is what you can control. Yeah. So this is within your control. This is within auditor's control. Very important. And what is detection risk? Detection risk is just the risk that auditors will not identify a material misstatement. Yeah, this is failure to identify material. Anytime I use material, we're talking about significant. But audit, we don't usually use the word significant. So don't use significant. Most time use material, because now you need to start getting used to the right word. So the failure to identify material error. Yeah, I will also say avoid using error gradually and start using the word misstatement. It's the same thing, but misstatement is more professional. Yeah, but it means the same thing, right? So use these two words, material misstatement. So, and what could cause that? Yeah, there are several things that could cause that. Yeah, it might be that auditor has designed bad procedure. Yeah. Bad procedure, it's popular. If you don't use the right procedure, you won't pick the right error. It might just be a basic human error and omission. Yeah. Humans are prone to make errors, or it might be lack of training. Maybe the auditors don't even know what to do. So the auditors has been poorly trained. Yeah, or just inexperience. Because, and you will start learning it. There are some balances that you don't just give a rookie auditor to go and work on. You need to give to experienced auditors. So these are the three components of audit risk. And what you must do is to make sure that detection risk is always low. So your objective as an auditor, yeah, is to ensure low, worst case scenario, medium detection risk. Because that is what you have control. You don't have control on inherent risk. You don't have control on inherent risk. You don't have control on control risk. But you have control on detection risk. So, if this is I and this is I, you know that this is already too much problem for you. You don't have control. The industry is highly risky. Then you know that your detection risk, you must do a lot of work. So, lot of work. You must do a lot of work to bring it down. Because like I said, your objective is to make it as low as possible. Yeah. But if it's other way around, if maybe this is low, the inherent risk is low, control risk is low, yeah, you can relax with detection risk, because industry has low risk, control failure is low, so you can do little or medium work. You still do work as an auditor, But let me not call it little, because you shouldn't do little work. Let's just call it medium work, just to make you know that you don't have to do as much. Yeah. So medium work. So you don't have to do too much work. And you later understand what I mean by lot of work and medium work as we progress. I don't want to start using those terminologies, but if you have read ahead or you have written this paper before, what I'm talking about here is a lot of work means you're going to be doing a lot of substantive test of details, and a lot of samples will be tested. Your materiality will be very low, but if your detection risk is allowed to be high, then you don't need to do so much work, and which means that you can just do analytics and you can test little samples, right? And the materiality can be quite high in that sense. But if you have not gone so far in your study, or you are just writing this paper for this first time, just follow me like that. Yeah, a lot of work if detection risk is meant to be brought very low, and if detection risk is allowed to be at a medium level, then you can just do same medium work, not too much work. And why will you do that? Because inherent risk is low and control risk is low. Yeah, or maybe one of them is low as well. Yeah, so that is how audit risk affects our work. And